Hello traders, Gary Wagner here just before 11 o'clock in Honolulu, 4 o'clock in New York on Friday. Happy Aloha Friday as we say on the islands, 16th day of January 2015, and this is the daily report for gold and silver, our weekend review. And what a week we have seen in the markets, precious metals surging this week, and we get a continuation of those higher moves today. First to gold, up over 1%, 1275 and change. We have seen a low in this market on a daily basis of about 1255. The high today has been about 1281, and as I said, we're currently up roughly $13 on the day, or a full percentage point. Now, in terms of percentage move, silver today is off the charts, up almost 5% on the day, about 80 cents, 1771. That is our current print. The low on the day has been under 17, call it 1670. The high on the day has been about 1781. More on silver in just a little bit. Of course, traders, we are long both gold and silver. I'm going to be talking about not only our current trade, but our exit strategy on today's show. But before we take a look at individual markets such as gold and silver, equities, the dollar, and oil, I want to bring up a chart that we'll probably never see again. I've never seen this before. And this is a daily chart, of course, of the euro as it relates to the Swiss franc. Now, of course, we had the Swiss franc yesterday get depegged or unassociated with the euro. They had been pegging it at roughly 120 right in here. And you can see that once that announcement came, this market dropped like a rock. Look at this low right here, only to finish right here at about 98. This is a one-day move that we saw. This, of course, is the recoup of today of that decoupling of the euro and the Swissy. Never saw it before. We'll probably never see it again. Which really brings us to gold. Now, we're looking at a 720-minute chart, standard candlestick format. If you recall, we were really looking at this long-standing resistance line here, and my belief was that as we were looking at this market trading within a range, my sense was that at the point we would see this market break out, either to the upside or downside, would be the point in which we initiated our first trade of the year. Now, that happened just last week, roughly around, call it the 7th of the month. And what happened was, as this market came up, you can see that it did break above that. It actually hit a high of, I believe, 1223. We entered the trade right in here at 1217.50. Did take a little bit of heat. We initially had our stop below 1200. That stop held very well. And then we saw this market really begin to track higher. As it tracked higher throughout this week, we did raise our stops. Our current stops are trading under 1225. The reason for moving the stops in that area was these series of lows, and my sense was that if this market was going to continue on this upward path, it really needed to hold this pretty critical level of 1225. It in fact did, and the rest, so to speak, is history. Market has been taking off and taking off solidly. Looks like it's going to close for the week at about 1275. That is a tremendous move to the upside. Interesting note, and we'll talk about that in a second, that corresponds to a 76% retracement at 1274. So traders, all I've done is I've gone in and compressed this chart so we can get a better sense or a feel for this current level, the 76% retracement, and where we're drawing it from. Simply put, we have one fib retracement going from this high at 1319 down to the low at 1130. When we do that, we get our various hash marks right in here. We also have one smaller fib retracement, which is this inside area here. And now that we've taken out that high, this is the fib retracement, of course, that has a lot more credence and a lot more weight to it. So traders, with this rally fully underway and immersed in higher pricing, we need to talk or spend a couple of moments talking about strategy for our current trade. Of course, as I said at the beginning of the show, we're in at roughly 1217. And as the markets moved up, we currently have our stop under 1225. We will look to move that stop up at the beginning of next week. But in terms of various targets and areas we want to look at, 1292. Now that is a 61% retracement. This, as I said, is a longer fib retracement coming from that high when it almost hit 1400, this being 1390 to 1130. So it's a pretty large range. We're a little bit a ways from there. So 1292 and then 1229. Those are the areas that if this market is going to continue on an upward path, we could see resistance fall in either here at 92 or here at 29. And to put that in a little bit a different perspective, I put back up our 2-day chart, and this 1391 is this top right here. And so that's the upper levels in terms of where I think we could, in fact, see this market go to. A very, very interesting note, of course, is the fact that we broke above this, the fact that we held this 61% retracement actually puts our bullish model back in play. The bullish model, of course, would be looking at something like a 1, 2, 3, 4, fifth wave concluding as what we call a truncated bear market truncation. And traders, in terms of a bear market truncation, I'm going to bring an image into view. That's this right here. And this is a illustration of that bear market truncation in which you'll have your series of 5 waves. So in this example, 1, 2, 3, 4. Your fifth wave is truncated, meaning your 5 and 3 are equal. And from there, you conclude the downward spiral and you complete your 5th wave here, and then this becomes an impulse wave here. And with that in mind, now that we're taking a look once again at our gold chart, again this 2-day gold chart, you can see where a correlation can be made. 1, 2, 3, 4. Fifth is definitely a truncation. We've got fairly equal lows. Of course, this was at 1180, this is at 1130, but in the big picture, if that was the case, this is starting a new impulse of 1, 2, 3, 4, and 5. We're pretty far away from me being able to say with any kind of certainty that we're looking at that, but if in fact that's how this market will unfold, these are the first signs that we'll see. We'll have to see how that plays out. We're long at, as I said, 1217. Regardless of how it unfolds, we've got a good trade that we're currently involved in. Now, one of the more interesting facts about how trading really finalized or concluded on this Friday was that crude oil higher, dollar higher, equities markets higher, silver higher, and gold higher. Across the board, we had these markets moving up. Now, on a monthly crude, you're not really seeing the move up, but we are back at about 48, off of these lows at about 44. The other thing that I find interesting and is worth us looking at is we've identified these couple of levels, 51, 55, 46, 22. They're both 76% retracements. And my sense was that this would be a place we would look at for potential support in crude oil. It's back up at this point. It'll be interesting to see if these levels hold come next week. Dollar resuming its utter tear and breaking above a former level of resistance. The resistance level that we were looking at was roughly at around 92. We had been playing with that, and this week we absolutely shot through there. We're now sitting at 93. To make some sense of that, if we go and compress this chart, here's what you'll see. Once we compress it, we realize the market has been trading in this area, but take a look at this. Traders, this is where I got our one level of resistance at around 92. Now, if we go up and just move this bar up to the next technical level that we could encounter any kind of resistance, it comes right at this point. You also see a gap right in here that, in essence, really has never been filled, at least since this market has been trading lower. So I'll find it interesting to see if we can see this market actually go in and fill that gap. But right now, our next real level of resistance on a technical basis in the dollar index falls at around 94 or 93.90 right here. It's based upon this top. And so we've got some more room to the upside. We've taken out all of these other tops that we've been looking at. Equities markets Also staging somewhat of a comeback today. It's been down dramatically. Once it hit these highs at about 2090, the market dipped below. I think in terms of an intraday low, we might have gone to 1985. We're well back over 2000 at 2012, and you can see on this weekly chart, by looking at this dramatic low here and how it moves up, the kind of recovery we've seen. It is substantial in that we finally have seen a ending to the dramatically lower pricing we witnessed all week. And today's recovery in the equity market becomes quite visible when we look at the 720-minute chart of the E-mini S&P 500. This is that dramatic move that we've witnessed back over 1985, which is a 38% retracement of this larger move here. Now, traders, the big surprise move, at least to me, has been the tremendous breakout in silver today as we see it move dramatically over $17, trading just under 17 at the open of the day. This is the spot chart, daily chart of silver. Our low 17 right here. You can see the market was trading below 17 when it opened. It is well above 17, closer to 18 now as we go into the close. Of course, we're long roughly at 1650, so we've got some nice profits building both in our gold and silver trade. Recommendation is obviously we're going to maintain our long positions in both gold and silver. In fact, if we see any kind of a dip or break to the upside, I am going to look to add to our positions, seeing as they've got such substantial profits in them. This is the time we would look to increase our holdings of long golds as well as silver, depending on how the market reacts and begins to trade once we get into next week's trading activity. This has been a great week. So as I say, this has been Gary Wagner, wishing you as always good trading. We certainly got that this week, the start of 2015. We'll talk to you on Monday for another daily update and review. Bye-bye.